welcome to this Thursday edition of FreightWaves Now. I'm your host Anthony Smith, and coming up, Donny Gilbert is going to give us an update for the brokers. I'll be stepping in with a shipper, bit of an econ update, but first we're going to go to Zach Strickland with the carrier update brought to you by PowerFleet. Stay tuned.
And welcome to your Thursday carrier update presented by PowerFleet. I'm Zach Strickland, and today we are hitting record levels in the outbound tender volume index. You can see here behind me that we have spiked at over 11,224, the highest level of all time since the index was created on March 1st, 2018, and that includes 2018 June, when we saw the levels at their early previous high level of just over 11,000. Now this is a pretty big moment. Again, everybody in the stock market is selling off, selling off, selling off. That is largely a service side issue, whereas freight is more of the material goods side. Now, there is a bit of a disconnect there, of course, because of the way that there's speculation versus what's actually happening. A lot of shippers out in the country right now moving a lot of freight across the country, trying to get in position as people are hoarding things, you know, panic buying to an extent. Again, as this situation progresses, the freight volumes are also progressing higher. This time last year, we were about 97.45. So we are roughly about 15% higher than we were this time last year in terms of freight market volume. Looking across the country, this tree map here that I have behind me, you can see still we have a lot of weekly increases in the tender volume index. Everything largely in green, not as much as we had this time a few days ago. We are starting to see a few more red spots pop up across the country. Stockton, California, for instance, was green a few days ago, as well as Milwaukee, Wisconsin. If you look back here on the map, you can see some of these represented here. Geographically speaking, a lot of the smaller markets across the country, again, large geographic areas, making it look a little bit more red than it really is. Some of these freight markets are not necessarily really large in geographic size. Bismarck, North Dakota, for instance, not a big freight market in terms of general freight activity, but pretty large geographically. So looking across the country, we still see the areas of Cape Girardeau, Ontario, Los Angeles, some of the bigger markets in the country, Allentown, Pennsylvania, also down here around southern Georgia, and also into Florida. So carriers that are moving freight in and out of Florida right now, we're seeing increasing volumes coming up and down, across the Florida Peninsula. So something to be aware of. But again, this one is really the point. Looking at the tree map, Seattle, Washington, Philadelphia, the biggest markets in the country are seeing, still continuing to see some of the biggest surges in volume overall, 19.7% out of the Ontario, California market. Looking at our weighted rejection index map, what is happening to capacity as this volume continues to be on the rise in the majority of the country? So you want to look at everything that is in white and up into the blues. These reds, not necessarily that big of a deal. You see we have positive values still in some of the lightest reds. The lowest value of the weighted rejection index is down around -2 right now. That's a pretty high low, if you will. So the market itself, don't get blown away by all the red on the map. There's still a lot of destabilization happening in the market right now. Outbound tender rejection index is up around 8.6%, still roughly just over half of what it was around Christmas time. So spot market activity is on the rise. Looking at some of these bluer markets, you see Harrisburg and Allentown, Pennsylvania. Columbus, Ohio is one of the bigger hub type freight markets in the United States. We're seeing volumes surge there and tender rejection rates on the rise out of Columbus. A lot of freight activity happens across this corridor from Chicago all the way over into New Jersey, Newark, for instance. Big corridor of freight, a lot of warehouses, a lot of DCs in that market. Tender rejection rates are spiking. Something of interest, though, is that they're not necessarily that high compared to last year. So even though they're coming up real fast, not as high as they were this time last year. Very interesting to watch. So that'll do it for today's Carrier Update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Thank you, Zach, for that update on volumes. Today, in the brokerage update, we're going to talk about tender rejection rates. My name is Donny Gilbert, and the reason I want to talk about tender rejection updates is because I want to look at what's going on with the actual prices in certain markets. So starting off today, I brought you our tender rejection rates for our reefer and our dry van volumes. Right here behind me, our reefer is in blue, and in red are our dry van tender rejection rates. Now, I've got this on a dual axis, so here on the right-hand side of your screen is the reefer tender rejection rates at 10.35%, and on your left-hand side of your screen are my dry van tender rejection rates at 8.83%. Now, of course, we see immediately this red line shooting straight up, and that's our dry van tender rejection rates. Over the past about 8 days, with all this volume is picking up, our tender rejection rates have soared up from here below 5% all the way to 8.83%, which shows a huge upward shift in spot market rates, the current market rates that are going on right now with this surge due to our panic over the coronavirus. Now, if you look at our tender rejection rates for reefers, they're still kind of going down some, but they're only at 10.35%. So it's still a healthy tender rejection rate for reefer, but as you can see, this panic has not affected the reefer market near as much as it has affected the dry van. Now, if I put all this on a single axis, this blue line would actually be up here above the red line because the 10.35 is obviously above the 8.83. But what I wanted to see was the trends. That's why I used a dual axis, so I could really see the angle going down here for reefer and the jump up here going up for dry van. Very important to see this because it shows us very closely what's going on with the direction of spot market rates. Now, jumping over to our lengths of haul, what are we seeing? What are these loads that are moving right now that are so important? Well, if you look at our tender rejection rates and break it down by our lengths of haul, you can see our short haul, 8.61% tender rejection rates, our mid haul, 10.33% tender rejection rates, and our tweener haul, 10.58. It looks like about 100 miles to 800 miles, those are the tender rejection rates that are moving right now. The lanes that are being most rejected, the ones that are the most tightest capacity for these lanes. So these are the ones where the rates are really pushing up right now. And if you want to jump out there and find these lanes, these are the ones that you really want to bid on. Say your short haul, but really probably your mid haul and your tweener haul. So, roughly 250 to up to 750 miles. Now, here on my right, your left, these are the top dry van markets right now. You see Augusta, Maine, of course, that's a huge market for moving water. Cape Girardeau, Denver, Colorado, Cedar Rapids, Jefferson, Missouri, Quincy, Illinois. All these are the ones that have the highest tender rejection rates, anywhere from just over 18% up to 36.38%. So these are some of the top drive-in markets right now. Definitely jump in and investigate these. I pulled up a heat map and sorted it by the value so I could see which ones were the actual top markets. Of course, green means they're growing and purple means they're neutral. On your left here, or my left, your right, I brought up our reefer markets right now. Little Rock, Arkansas tops it off. Des Moines, Iowa, Minneapolis, Minnesota. Now, keep an eye on your Florida markets right now because peaches, they just started harvesting peaches today. So here we see no effect much on the reefer markets, but produce season is right around the corner. If this corona epidemic runs into the produce season, it could be a huge impact as well, and we'll see reefer start jumping as well. I appreciate you guys tuning in today, and that is your brokerage update for today.
Voices from every corner of the supply chain concerning all modes of transportation. From the world's largest logistics podcast network, this is what the Freight Tech Revolution sounds like. Freightcast presented by FreightWaves. Subscribe now wherever you get your podcasts.
Welcome to your shipper update. Besides the host, I'm also the lead economist here at FreightWaves, and today I have a special econ edition of the shipper update. So behind me I have weekly jobless claims and retail sales. And so one of the things that we're going to do is look at some of the underlying trends within the economy and how it might impact some of the shippers out here that are exposed to some of these areas. And so as I said earlier, I have weekly jobless claims behind me here, and that's going to be in the purple line, and in the orange line, reddish line, we have retail sales. And so what we can see is that there's an inverse relationship here. We have this spike up in weekly jobless claims earlier in the 08-09 time frame, opposite here, we have in the orange line that dip in 2009. And so we can see that there's an obvious inverse relationship. When jobless claims are high, that means that retail sales are high. There are weak underlying fundamentals. So one of the latest numbers we saw for unemployment was that it recently dropped down to 3.5 from 3.6. Now this is good news. A lot of people don't really like to use the unemployment number just because it might not capture what the true market is. I like looking at the weekly jobless claims because it's a little bit more up to date, and it comes, like I said, it comes out on a weekly basis. Slightly volatile, but it gives an accurate depiction of what's happening right now. It really gives a good show of the pace of layoffs in the overall economy. And what we can see is that although there are tons of fears around the coronavirus right now, that hasn't quite impacted weekly jobs claims or the pace of layoffs. The other area to really be mindful of and watch when you're looking at the underlying trends for the consumer, because that is what's moving the overall economy, the consumer, is going to be looking at job openings. Now this is going to be an interesting area to watch because job openings are really going to be that foundation for employment. And so we can expect to see potential slowdowns. We already have seen slowdowns in job openings, but further slowdowns around job openings when there is a little bit of a hiring freeze because of traveling concerns and things like that. So moving on to our next chart, as Zach mentioned earlier in the carrier update, volumes are increasing at record levels. And so what we have here in the purple line is outbound tender volumes, but in the green line we also have the LMI, the Logistics Managers Index. And excuse me, this is broken out in different components, and in this green line here, I have the component for warehouse capacity. So what we can see is that there has been quite a pull forward and a lot of volume here in this purple line, as we see that volumes is spiking, and in the green line here, we can see that warehouse capacity is open. And so that's really telling us that there is a lot of warehouse space open. There's just a lot of depletion going on right now. There's a lot of movement of goods, and what we can see here in conjunction with the LMI that's put out by the good folks at ASU, Colorado State, Reno, Nevada, Rochester Institute of Technology, and I believe there might be one more, so sorry if I forgot you guys, but the LMI is a good representation of what's happening in the overall logistics industry, not just on the manufacturing side, but on the consumer side as well. Next up, we have total revolving credit. So this is going to be something to be mindful of. Here in the purple line, and in the orange line, we have home purchasing sentiment index. So in the orange line, that's going to be something that's less revolving, but it's going to be a good indicator of where consumers' heads are as it goes to making big ticket purchases and other big ticket items that might go into a home. So what we're seeing is that there is a slight decline in the latest number for the revolving credit, outstanding credit for consumers. Bit of a good news, but we don't want to see this come down too much. We want consumer spending, but again, we don't want them overextending themselves. Other thing that we see here is that the home purchasing sentiment index is still relatively high. This is telling us that consumers are still feeling optimistic about the overall industry. Next up, we're going to look at construction spending. We can see that construction spending is still very high and that consumers are still very active in the green line here. So that's going to really give some added volumes to flatbed capacity here. And last but not least is going to be non-defense capital goods new orders here in the purple line. That's going to be an area I would suggest all of you shippers that are exposed to manufacturing to watch, because that's going to really be a sure shot sign of when there is going to be some manufacturing activity picking up. That was a lot of information, but thank you so much for tuning in. If you're looking for more, always feel free to reach out to us. That's going to do for today's episode of FreightWaves Now. Thank you so much for tuning in, and we'll see you on the next episode.